Good morning and Happy New Year. Dan Delmar in for Elias. One more day. He is back tomorrow. Interesting story out of Costco, actually. I know Elias is really obsessed with Costco. I can't go to Costco. It's really too much trouble. But they've got a hot new product. It's actually a hot old product. It's called Gold. Gold bars. Costco is just selling out of gold bars. Apparently, they're selling them not at the stores but online, and it's a major revenue generator for Costco. And gold has been up a little bit in recent years, probably, I assume, due to some economic turbulence, seen as often a safe commodity. Let's dig into that a little bit now with William Higgins, Assistant Professor of Finance and Business Economics at McMaster University. Professor Higgins, hello.
Hey, good morning.
Thanks for joining us. So we have this, again, this rush back to gold. Is this another kind of cycle where people feel unstable in the market and looking for that safe commodity investment?
100%. We saw this almost exact same type of thing play out about 10 or 12 years ago. In 2012, we saw the price of gold surge upward rather significantly on people's expectation that the world was going to fall apart, that the euro was going to collapse, etc. So a lot of people moved into gold. Price moved up about 25-30%. And in the following year, it gave it all right back. Price dropped from $1,800 an ounce down to about $1,250 an ounce. So bubbles happen in gold, absolutely. Price rises, price falls. It's a tricky thing about that particular asset class.
Well, generally speaking, if people are buying up a lot of gold, significant amounts, what does that say about an economy?
Usually it says that people are worried because there's a long-standing bit of mythology around gold. Things like this will be a hedge against inflation. Everyone repeats that, but most of them don't even know what hedging means. The idea is that people are concerned that, say, the price of the U.S. dollar or the Canadian dollar will collapse, will fall apart, that the governments who borrowed all this money won't be able to honor their debts. And there's this notion that, well, if it all falls apart, at least I'll have gold. But it's not a very well thought out proposition, because if this turns into Mad Max, who's going to buy your gold is the most important question. So there's a little bit of mythology around why people tend to flock to gold when times are tough. And quite to give it a little bit of honor, it is worth noting that in some places and times when things do collapse, people want to flee the country with whatever portable wealth they have. So, we saw this sort of thing happen in like Poland in 1939, where people went to gold and tried to leave the country as fast as they could. But barring some kind of geopolitical disaster like that, it's really hard to imagine where Canadians are going to take their gold and walk to. So it's a bit unusual, right? The mythology kind of carries over from places where you see state collapse, like Somalia or Venezuela. And people are like, well, the government fell apart. Maybe if I have some real material wealth, I could take it somewhere. But that's really not the situation in North America, where we have Costco and now Walmart selling gold and silver to people.
Indeed, that struck close to home when you mentioned Poland, because my Polish late grandfather did just that. He had to collect a bunch of gold in order to facilitate his immigration to Canada, but unfortunately, the Polish authorities confiscated it all, and I don't know how they ended up here. Some combination of favors and bribes, I assume, but that hit home, and that was it's one of the reasons why people believe in gold so much, because you can actually cash it in virtually anywhere around the world. But for how much longer will that be true? I wonder. I've seen there's some artificial minerals, diamonds and gold being explored now by startups. Could that potentially devalue gold?
Historically speaking, anything we want to be our medium of exchange has been our medium of exchange. We used to use seashells and coffee and tea and silk, all kinds of different things as a medium of facilitating trade and exchange. Gold historically ultimately came from the fact that we were trying to mine copper, because copper was better than stone tools back like 8,000 years ago. And inevitably you pick up little bits of gold and silver that comes out in the smelting process, and they're very pretty metals. So it took a long time before there was enough gold for anybody to start actually using it as a medium of trade. But the idea at the end of the day is that we could engineer almost any kind of fixed store of value. We could choose diamonds. We could choose water. But the biggest things is that usually you want it to be portable and to have a high amount of value to weight. So it can't be too plentiful if it's supposed to be valuable. It's got to be a little bit rare. So if we could artificially make a lot of gold, it really would lose its mystique almost overnight. Like if we imagine, I don't know, Bezos or Musk gets in their rocket and drags back a giant meteor the size of Edmonton that's made entirely of gold, we're not instantly rich. What's going to happen is the price of gold is going to crater. And it won't buy anything because there'll be so much of it.
It's interesting. Gold has this mystique around it, I think, partly because it's just so pretty. I think that a lot of it comes down to that. Is this...
It's pretty. It's got cool chemical properties. It's easy to make into jewelry. It's malleable. 1,000 years later, there's just as many atoms as otherwise. It doesn't oxidize. So it's got lots of, mystical type properties if it's, 3000 BC and you don't know chemistry.
Would you consider this in 2024 to be a part of a mainstream portfolio, or is it kind of off to the side somewhere where you wouldn't necessarily recommend people go?
Well, first off, I always have to be careful about financial advice. As professor, you generally fall under the legal category of expert, and it's dangerous to give advice.
Fair.
So in the interest of not being sued, I would generally say diversify widely. It is the smartest thing for people to do who don't have a deep understanding about finance or econ or markets and trading. So in that sense, if you are widely diversified, you may very well own some precious metals or companies that produce it. Like if you bought a Canadian index fund, just a little piece of every company on the TSX. Well, a bunch of those companies are mining companies, most of them actually. And then within that, several of those end up extracting a little bit of gold along the way. So just by owning a Toronto Stock Exchange index fund, you end up with a little bit of exposure to gold in your portfolio anyways. That said, there is a very reasonable argument to be made for holding certain kinds of commodities in a portfolio. The risk of doing that, though, is that commodities are effectively stale. They don't grow, especially mineral commodities, right? If we're talking about wheat or orange juice or something organic that produces seeds, or we're talking about like hogs or cattle, well, those grow, right? Not only physically, but they can reproduce. Something like oil or gold is, a sterile commodity.
Yeah, and especially because we're
over time, there's no yield,
and we're trying to climb out of a recession adjacent kind of area here, and in dead capital isn't really the way we're supposed to crawl out of that, right?
Well, it's tricky. It can be useful to have some of your stuff sitting idle. So in that sense, I would not say that having gold in your portfolio is a bad financial choice. What I tend to think is a bad choice is like investing in gold via a gold bar. That's always a little questionable to me. I think there's more efficient ways for us to do that. People used to buy jewelry as a way of getting access to gold, and that's very expensive because you're paying for craftsmanship, you're paying for the retail rent, etc. So gold bars was always a little bit more of a pure way of investing in it. But even then, you still have to pay somebody to smelt that gold, to stamp it for its purity. You're going to have to pay a broker to sell it to you or a broker to buy it from you. So there's always a cost of getting in and out. But the big one is, where do you put it? Right? If you start storing gold bars at your house, you're basically inviting thieves. It's a dangerous proposition. So you would have to insure it. You would have to provide security. So a lot of people would use a safety deposit box, right? Like $30-40 a year at your bank, and they'd keep their gold bars in the bank. But I would remind people, if you're doing this as a Mad Max style hedge, you're not going to get access to your bank. If civilization falls apart, you're hoping to escape, you may not get access to it. So it becomes tricky. That's why, historically, you had people burying treasure in their backyard and not coming back for it.
Well, thanks very much for
this. Knows the money's at the bank, so that's where the bank robbers go.
Thanks very much for this look into gold and how it can be at least a small part, perhaps, of someone's portfolio. William Higgins, Assistant Professor of Finance and Business Economics at the DeGroote School of Business at McMaster University. Thanks and Happy New Year.
Have a great day. Happy New Year.